What used to be considered checklist compliance is shifting to actual judgment, and your risk factors might be scaring away more than just your investors.
Plus, we're looking at a capital markets explosion that's been sitting on the sidelines. The IPO window isn't just opening, it's being pushed wide open by AI and a massive backlog of unicorn companies.
We've got SEC signals on materiality, the coolest lawyers in the room right now, and how technology is cutting months off the deal cycle.
Welcome to the pre-read.
Just like the slides you get before a big meeting, the pre-read prepares you, CFOs, and other executives for the next big thing. It's the global podcast where finance, sustainability, audit, and risk teams come together in the C-suite.
If you're making decisions at scale or need to understand the leaders who are, you're in the right place. This is the pre-read, brought to you by Workiva.
I'm Alyssa Zucker, sustainability nerd and equal opportunist caffeine addict.
And I'm Mike Gravano, pre-read producer and recovering cherry Coke addict. What do we have cooking up today, Alyssa?
All right, well, sometimes, or really all the time, it feels like there are so many things changing, and it's hard to keep up. So in this episode and the next one, we'll be checking in on different market updates. Today, we're tackling SEC updates and high-stakes world of IPO readiness. First, our host in absentia, Steve Soter, sat down with financial reporting expert Chelsea Hall to unpack how the SEC is rethinking the very definition of materiality. If you've been treating your 10K as a CYA exercise, the SEC has a message for you. It's time to clear the clutter. What stood out to you about their talk, Mike?
The time of judgment is nigh. What do I mean by that? The SEC is moving away from quantitative thresholds like the 5% or 10% rules for immaterial items, signaling that the CFOs have to re-anchor their disclosure process in true materiality rather than a simple checklist compliance. Also, we're looking at a risk factor paradox. So many companies are over-disclosing in the risk factor section to reduce litigation exposure, but it's often ignored by investors. So the goal now is a crisp, concise, and digestible MD&A that informs rather than obscures. How about you, Alyssa?
Well, what jumped out to me is the tariff refund opportunity. Following a Supreme Court ruling, companies may be eligible for pretty significant tariff refunds. And CFOs need to evaluate their accounting models, specifically loss recovery versus contingent gains, and decide if they should disclose potential recoveries to investors now. So with that, let's go to Steve and Chelsea.
I recently had the opportunity to attend the annual SEC Speaks conference, and for those who aren't familiar, this is an entire conference with just SEC speakers talking about what's on the mind of the commission, from enforcement to rulemaking. The one that we had just most recently did not disappoint. So wanted to highlight a few things that I heard there, and the first was about materiality. It was mentioned in pretty much every session, and especially the ones that I think would matter most to CFOs. Some of the things that stood out to me is that the staff emphasized that quantitative disclosure threshold, so this would be like disclose it if it's above 5% or 10%. They said, hey, those don't apply to immaterial items, meaning that judgment is going to matter more than those bright lines. And that's a change from what the commission had been saying only a few years ago. They also extended a materiality discussion to clearing out clutter and unnecessary disclosures and actually refocus on what really informs a reasonable investor. So, Chelsea, I know you have been paying attention to materiality for a long time. From your experience as a controller, where do you think teams are over-disclosing today when it comes to maybe this evolving notion of materiality that the commission's been talking about?
Well, I'm probably not going really out on a limb here, but I think the risk factors section. I think if you're any investor looking at risk factors, if you took all of those to heart, you would probably never invest in any company. I definitely think risk factors has become more of an area where companies are trying to reduce their exposure to litigation, and it's not really viewed as being a meaningful section to most readers of financial statements. And I think there's a reason, if you were to ask the investor community when they're looking at a 10K or a 10Q, they probably put more weight on the financial statements and the footnotes and probably a crisp and concise and digestible MD&A, and probably less weight on risk factors. And I think financial materiality is more embedded in those financial statement sections, the MD&A section, and then risk factors, everybody discloses everything. It's more of a CYA or cover your ass approach than really informing investors. I think really current definition of materiality is maybe a little bit too subjective. Sometimes I think it might help if they were more prescriptive in the definition of materiality at the SEC, so filers would feel like, it's okay for me to exclude this information, instead of feeling they have to disclose everything.
I think you're spot on. And actually, Chair Atkins specifically mentioned risk factors and exactly the phenomenon that you're describing. And between his comments and other comments, they extended that out to MD&A, even some of the footnote disclosures. I think really this takeaway for CFOs here is that you've got to re-anchor your disclosure process on true materiality as it's intended, as opposed to checklist compliance. So the second thing that I wanted to talk about from SEC Speaks was rulemaking, and actually rulemaking beyond semi-annual reporting. We've talked about that extensively with you, Chelsea, here on the podcast. But I think what people can be preparing for is a simpler but more consequential reporting regime, meaning a little less complexity, higher accountability. And I think that's important because to the extent that more judgment is going to be allowed in what you disclose and what you determine as material, I think you really need to be standing by your decisions. It's not like the Wild West. It's going to be where, hey, this is what we are disclosing, this is what we're not, and here's the reason why. There is active work going on, filer and reporting status simplification. So that would be based on size of the company, which impacts the timing of when they report, but also some of the benefits that you could get, for example, as an emerging growth company or smaller reporting company. I think we're going to see those benefits extended both for the number of companies that they would apply to, as well as the duration that those benefits would apply to. And I think that really could help open up the capital markets for some companies that have been sitting on the sidelines. But again, this gets back to that notion of, hey, if you can only have to disclose what's most important, be sure that you're ready to kind of stand by your judgment. Chelsea, as someone who's lived through these kinds of rule changes, what should finance teams be doing right now to maybe stay ahead of some of these changes that we anticipate in the near future?
I would try not to get out too far in front of it, but definitely stay informed. And one thing that I always felt was the most important is I always like to consider stakeholders outside of the financial reporting team that I'm going to need to meet with or leverage or get their expertise when it comes time to deciding how to implement the standard and for actual implementation. So I think a lot of these proposed rules you've discussed around disclosure, even semi-annual versus quarterly disclosures, it's really, if you're in financial reporting team, meeting with your external legal counsel, internal legal counsel, as well as investor relations, and deciding what these new standards or rules might mean for you and your team and how you're going to address and document the change in standards for your own implementation once they do get released and become final. In the meantime, don't stop maintaining your current processes and systems and controls. If you're an emerging growth company and you're anticipating this change in the emerging growth company definition, I wouldn't stop with your controls implementation, because at the end of the day, you're going to need to have those processes. You're going to have to maintain those controls. And I think your disclosure controls and procedures are going to be relevant regardless of the volume of disclosures in your financial statements.
Yeah, it's such a good point because, again, let's say there's some changes to Reg SK, like in your MD&A or risk factors, those types of things. That's one where, for example, investor relations, you might need to be sure, like, hey, what's our narrative? If we're going to be able to focus on the things that matter most, what exactly could that look like? And start to think through that right now. The last thing that came up at SEC Speaks, which I thought was really interesting, was a discussion on tariff refunds. And while this might seem like a little bit of a niche topic and with a high degree of uncertainty right now, after the Supreme Court ruling that struck down the administration's tariff announcements from a year ago, I think a lot of companies are asking, hey, could I actually be getting some money back? How would that impact the accounting or maybe my disclosures? And I think the thing to think about is that if those impacts might be material, whether it's asset, liability, inventory related, whatever, now is the time to be thinking about the probability of that happening but also if there's any disclosure implications. So, Chelsea, I'll ask, if you were talking to a company who's thinking about refunds, at least the possibility of refunds, what would you be telling them to do right now?
I think first, let's talk about the timing of the Supreme Court ruling, because I think that really did impact like a lot of filers probably. The ruling was on February 20th. So I think a lot of companies filing their 10K, if they hadn't filed their 10K yet, they were asking themselves, how does this fit into my 10K filing? And if you were to go look at 10Ks, there were a handful of subsequent event disclosures about the impact of this ruling. I think it will be interesting in Q1 to see what companies disclose. So I think that's going to be something I'm hoping we'll get some more clarity on what companies are actually doing. And as you are preparing for Q1, this topic actually is probably really relevant. Like you are maybe asking yourself, should I be disclosing something about these tariff recoveries? And I think the unfortunate thing is, although the Supreme Court ruled that these tariffs weren't constitutional, they didn't provide any guidance, or they didn't decide on whether or how tariffs previously collected by the U.S. Customs and Border Protection should be refunded. So with that, there's a lot of uncertainty on how you should be accounting for these potential refunds. I want to keep this as brief as possible, not get too far into the guidance, but I think right now companies have two models they can be looking at on whether or not they should be recording any type of asset or receivable related to tariffs. One of the models you could look at is the loss recovery model under ASC 410-30, or you could look at the contingent gain model under ASC 450-30. When you hear ASC 410, you might be like, that's environmental obligations. How does this relate to tariffs? It is often applied, that standard specifically is often applied by analogy to other situations where loss recoveries are expected. There's kind of a lower threshold there, a probable threshold when you could actually record an asset. That one might be more subjective, and you might have to apply more judgment on applying that loss recovery model. I think the more simplified approach would be to apply the contingent gain model. And as a reminder, if you have a contingent gain, that's really based on when you actually get receipt, when it's receivable, and when it's realizable. And so there, you're not really recording anything until you are guaranteed, or you're almost certain you're going to be receiving a refund for these tariffs that have been previously paid. Also important to remember, under the gain contingency model, disclosure is important here, but when you do disclose receivables or potential receipts under the gain contingency model, you should only be disclosing those in your financial statements when those receipts are probable. And you want to make sure you're not misleading investors as to the collectability of those potential tariff refunds.
Yeah, and to me, the complexity speaks to, number one, the need to be getting ahead of this, as opposed to waiting until something happens, having to start cobble all this stuff together. But number two, how important disclosure could be. Again, if you're a company that was significantly impacted by tariffs, I would expect investors and others to naturally be wondering, like, okay, could there be some kind of recovery? Could there be a refund? If so, what might that look like? And even if there's no accounting today, as in like journal entries and receivables and that kind of thing, again, I think disclosure right now could go a long way. Back to our point about materiality, if you're one of those companies where you'd be impacted, I think disclosure could go a long way into communicating that to investors.
I have heard that like tariff lawyers are like the hottest lawyers out there right now. So kind of like how accountants were the coolest people in the room after Enron, tariff lawyers are like the coolest people in the room after these IEEPA tariff back and forth rulings.
Well, and it would make sense, because if you've got a strong legal position, you've got confidence in your counsel who'd be able to argue it in your favor, why wouldn't you? Pay an attorney, pay some legal fees, go through a process. Hey, if that helps me recover, I don't know, tens or hundreds of millions or whatever the number is, why wouldn't I pursue that? And again, that to me gets back to the heart of like, well, hey, you need to start thinking through the accounting and the disclosure issues right now because you don't want to be caught flat-footed again if something happens, either a ruling in your favor or the other direction, and then suddenly have to wonder like, okay, what are my disclosure obligations? Because I think even that by itself could open up disclosure controls and procedures issues or other ICFR questions like, hey, how good is your process really if you weren't anticipating this as a potential disclosure item? I think to me, it really gets back to like how robust is your process? And are you going to be ready to defend this to an auditor or, speak with confidence to an investor? Because I think they're naturally going to be asking these questions.
Well, and for companies that might find themselves in need of cash, there are, not surprisingly, firms out there, finance firms that are offering companies 50 cents on the dollar for the tariffs that they paid under IEEPA. And so I think that's something else to consider. Is it worth taking 50 cents on the dollar to get your tariff refund now, be able to record it now and help your liquidity? Or do you wait it out to see how this plays to the courts or until a process is set up? And who knows how time consuming that process could be to get that refund where you have, like I said, the firm's willing to take their own cut and help you now with your liquidity.
Sometimes flipping the cushions on a couch, as gross as it might be, can have a big payday. So it'll be interesting to see what the companies find out.
If you're a leader in insurance finance, the quarterly close isn't just a deadline, it's a gauntlet. Between US GAAP, statutory reports, and evolving NAIC requirements, teams are drowning in manual reconciliation. In fact, 47% of finance professionals say over-reliance on spreadsheets is their biggest frustration, leading to burnout and costly errors. It's time to stop chasing data and start analyzing it. Workiva's new guide, Insurance Financial Reporting Reimagined, shows you how to build a connected data advantage. Imagine a single source of truth where your policy, claims, and investment systems are all linked. When one number changes, every filing, board deck, and SEC report updates automatically. We're talking about a 208% ROI and cutting audit time by 40%. Don't just survive the next filing cycle, master it. Download the guide and shorten your reporting cycles today at workiva.com/PR-connected. That's WORKIVA.com/PR-CONNECTED. Now we're shifting gears to the market landscape with our cat mar connoisseur Josh Gertsch. While the start of 2026 felt a bit delayed due to regulatory backlogs, the floodgates are starting to open. But the quality bar has moved. If you aren't ready to hit the window on day one, you might miss it entirely. What were your key takeaways from Josh?
The first was that the rule of 40 is back. Investors are being more selective, focusing on companies that hit high-performing metrics, specifically requiring that combined revenue growth and profits margin exceeds 40%. The second was AI as a deal accelerator. AI is actively cutting weeks and months off the IPO deal cycle by streamlining both due diligence and registration drafting. Mike, what stood out to you?
That there's a shift in readiness strategy. Companies can no longer wait for their IPO window to get ready because windows now open and close so rapidly. The readiness efforts, including digital transformation and tech stack optimization, has to happen way earlier in a private company's lifecycle. Also, is this 1980s rock band Scorpions? Because there's a wind of change. Regulators are pushing capital formation through potential shifts like semi-annual reporting and extending emerging growth company benefits, all aimed at making it less costly and more attractive to be a public company.
All right, well, while that musical reference might have gone over my head, this conversation didn't. So let's get on to our dialogue with Josh Gertsch.
I think we all recognize that we are living in very interesting times from a market dynamic standpoint. And so I think the one thing I've always loved about cap markets is how much energy is there and how much activity is there and how much it changes. It definitely keeps it fresh. 25 was a great year. It kind of got us back to like a stabilized, what I would say like pre-COVID, pre-22 era where we went really high with IPOs and really low with IPOs. Now we're kind of back to a little bit of a steadier state on where it normally was before those big swings. The expectation, I think, coming into 26 was like that it would be gangbusters. And not that it's not, because there are a lot of companies going. There are like over 800 unicorn companies out there looking at an IPO. And then we've had a significant backlog for years of IPOs. There's a lot of known IPOs that are happening with really big companies and really big industries that are going to come forth like a little bit later this year. So activity is picking up. It's doubled from last year already. Like it's definitely like moving. But, the government shutdown was real, like to this market. Back in December, the SEC was talking that they had over 900 registration statements in cap markets that they hadn't reviewed that they had to get through. And that queue isn't all the way cleared yet, even in Q1. And we still think there's a couple hundred out there that they're like still trying to like get that backlog on. And it's causing that flood of activity to just be like a little bit slower than we would hope or we kind of expected. But that like queue clears up. I mean, we talking to the investment bankers and everyone else, like there's more companies that want to go than there is bandwidth to support them. And so now it's getting back to they are being a little bit more selective, but we do expect like the regulators to catch up. And we do expect like a huge spike. As many people that can go are going to try and go. Because so many people are going to come to market with it, we do think that there's going to be a quality issue where bankers are only going to pick companies who are really have like good financials and are profitable and are growing. Like we're going to get back into qualifying what companies go and like how they're going to price. So there's going to be a little bit of selection over quality on matching that up. And we're clearly aware of like some things happening in the world that impact the economy with energy and fuel prices and things like that. And what is interesting is if we were sitting here 2 years ago, it'd be like, oh yeah, I think that would have moved the market significantly. I think now the market is so resilient that it looks at that stuff and it reacts in about a week and two, and like we move on. It's just, we've had so many of these volatility like things that have happened to the market that it's so used to it that I think it adjusts quicker and it's going to move on and going to be like a very good path for companies to continue to raise capital. The market is definitely moving, far more active than it was last year. We expected an explosion, which we think is coming, a little bit delayed because of the regulators. We know the regulators are pushing capital formation. It is the political agenda that they want companies to go public. They want smaller companies to go public. They're going to clear out anything they can to make that as possible as they can from a regulation side. And then honestly, like we think the market's probably going to hold. And if it does, there probably is still like a huge demand of public companies that are going to happen before the end of 26. And I think a lot of companies are going to want to maybe get in front of like the next political election cycle in the US. All of that is like factoring into what we could see as a very, very active like later half of 26 from a capital markets IPO perspective. I'm going to speak maybe a little bit more to like just IPO readiness and execution. There's an interesting shift here that is happening that we're seeing. I think it's happened long enough that we know it's real. But what happened before is I think our IPO windows were open a little bit longer, or we knew we would have cycles that would be like, hey, it's probably going to be off, but then it'll be on. And then when it opens, it's going to be open for a few months. Clearly, the last 4 years have taught us that those windows can open and close like very, very quickly. Before you were always kind of calendaring your IPO, like, hey, we'll wait for the window and we'll go, or we'll finish getting ready to go. There's been a fundamental shift in the industry now where like, hey, you get ready. And when the window's open, like we're hitting it on like day one, like we're not waiting anymore. And so those readiness efforts that we talk about is kind of how to like resource the demands of being a public company. And what we're seeing is there's not much appetite to solve that resourcing demand with hiring folks. You better be leveraging technology and AI to do it to some extent. When you go public, typically like private companies have to invest in investor relations, have to grow their accounting and finance team. They have to grow their legal team to do, all this compliance and reporting and things like that. Readiness efforts, you're looking like, how am I going to do this? Am I going to hire folks? Am I going to go get advisors to help me? Or am I going to leverage technology? The appetite now is to leverage technology and AI to the greatest extent that you can. What we're seeing is people are kind of combining like an IPO readiness motion with like their digital transformation motions, and they're kind of becoming one and the same. Like we are seeing not only companies, how they do their accounting and finance and how they up-level their legal functions, like the use of AI is making those functions more productive. But we're actually seeing AI come into the process of like making the IPO go quicker through like what we call like a deal cycle. So typically if you want to do an IPO or looking at maybe another strategic transactions, you start with due diligence, months going back and forth, asking questions like, hey, if a company comes in or investors come in, like we want to take you public, we need to know about you. We want to know what makes you great. They go back and forth for months of questions, and then they'll kick it off and decide to, file a registration statement. And then they'll go through an SEC review process, and then it goes effective in their public company. What we're seeing is because of AI, they can get through those questions and that due diligence so much quicker than rather than this life cycle taking 9 months or a year to kind of go from that piece to getting through the registration statement and going effective. Like that could be a 6 to 9 month process. Like we're starting to cut like months and weeks off this process because of what AI can do to help people feel more comfortable with, yeah, we know this company, we know what it is, we know how to price, we know what it's worth. And then we're also seeing like as the deal team gets together, we're drafting an S1 or a registration statement to go public, like they're leveraging AI and they're leveraging technology to help them like with workflow management. I think the overall impact that AI is bringing is it's starting to cut down on the days and weeks of like what these transactions used to take, which should make it easier to do these transactions and actually probably make it so that there's a desire to do a lot more of them because it doesn't take so long. I think we're actually just at the beginning of this trend, but we actually are starting to see it like play into account more and more in companies' timelines and just the whole deals environment that exists out there today. We're talking about how that process is played out for IPOs. I mean, there's going to be probably a 3 to 5 times more multiple or impact in the M&A space. There's probably 5 times more M&A deals than IPOs that happen every year. And the process is very much the same, like where a company comes in and they want to acquire someone or they want to merger with them. There's so much due diligence that has to happen where people are going to want to make sure they know what they're buying and they want to understand the numbers and they want to understand the company's story and what makes them great. Like, I think we're going to see that process be significantly like condensed down, and we're going to see a lot more companies like act very quickly on taking advantage of like opportunities of like, hey, we're seeing this company, we can get through the process of feeling comfortable that we should buy them, and we're going to go a lot faster. We do see, due diligence, I think, is going to change dramatically in the M&A space and be cut down significantly, which I do think, think about what we were talking about with the regulators before. They are all pro capital formation. They're pro strategic growth. They're changing regulations to make it easier to do these deals. Plus, the leverage of technology, like you have a couple accelerators here that could really change the game going forward. I'm positive they will, and I actually don't think we'll ever back up. Like I think things are just going to continue to get quicker, and those, deal cycles are going to get much, much shorter as we get more comfortable with AI and are more comfortable that the data we're looking at is good. Like that's still the problem a little bit. Like, hey, AI can look at all this stuff, but did it capture everything? Do we have all the data? Did we make sure we got everything in the deal? Once you have that assurance and you can get everything kind of there where you can look at it and make decisions on those deals, you could start cutting deal cycle times in half, honestly, and do think we're heading that direction to some extent.
Producer Mike hopping in here for a second. We all know a hot topic in the regulatory space right now is comparing quarterly reporting to semi-annual reporting. So when we think about what the impact is going to be on the IPO market, anything that reduces regulatory burdens for public companies should encourage more companies to go public. But it seems to me that companies that go public will still want to give investors some sort of update on financial results every quarter. Let's see if Josh agrees.
The option of semi-annual reporting is like, yeah, we don't have to put financials out there as much or talk about things as much. Like if you're a newly public company, like you want to continue to promote your company. You want to continue to engage with the investor community, and you'll find ways to do it, which effectively you're going to continue to talk to them anyways. And if you're not putting out a quarterly, set of financial statements, like you're probably going to issue an 8K or something, or a press release where you can talk about that stuff. And then next semi-annual filing, you'll do the reconciliation, the SEC reporting standards require to do so. But I don't see it as a negative. And in fact, I think it's just one more thing that the regulators are doing to give like a breath of flexibility to companies where, hey, you're going public, you're engaging, you're trying to do all these things. You're coming into the quarters. Like we know it takes a little bit of time to learn how to become a public company and like get all these processes down. If anything, it gives them just a little bit of reprieve and a little bit of flexibility there, which should make it actually more attractive to go public to some extent. And so I do think that's another thing where honestly, we have 300 to 400 companies that price an IPO every year, which means there's 600 to 700 companies behind the scenes, like working on IPOs that may or may not go. You could see another 20% increase because it's like, yeah, I know I can get ready and be a public company, and I have a little bit of flexibility on being able to do that and then like have the infrastructure needed to be a public company. There's always so many things to look at when companies are going public, like what's the market doing? It feels like we wake up every day and we're bombarded by a new crisis every day. And what's the impact that that's going to have? What's happening with the regulation? And I think that's trending positive. I mean, I think if companies are looking to access public markets, like now is a good time. And I think the main thing that I think if we can impress upon people doing it is like that shift in readiness. Everything is moving faster with AI and, regulations coming off. We have all these things that are doing nothing but accelerating these deals. I think that the crux or the challenge that it can put on people is like their investors, or if you're owned by private equity or VC, like these deal cycles are going to be faster and like, cool, we want to go public. Like we want to go public in 3 months instead of 9 months, and we're changing timelines. The piece of advice we can like share is like, you have to be ready. There's no longer like this option of like, oh, we're going to do it. It's time to get ready. Like the issue is like, you have to do it now. Like you have to get your technology infrastructure in place and figure out your tech stack and figure out AI and how you're going to do those things. You have to do it now, because you're not going to have as big a grace period or as big of like a readiness window. Like that is going to be compressed significantly. So I think the shift that has to happen is, hey, if you're a private company, like you need to invest in digital transformations and you need to get ready and you need to figure out how you're going to resource those things, because things are going to do nothing but pick up. And I do think we'll see those readiness efforts shift earlier in like a maturity of a private company where they're doing that like much more time before the deals are happening. Like I think that's all but coming. And hopefully we see a change in governance where there's a promotion for this, where boards are saying like, we recognize this, let's find the budget, let's spend the dollars to do this, because if we are going to live in this world and we are going to do deals, it's going to go fast. And like, we're not going to have the luxury of a grace period to try and get ready for them, honestly. So again, that's the biggest trend we're seeing. It's the biggest piece of advice we can impart is if you can get ready earlier, it's going to do nothing but provide more opportunities. And honestly, being a public company should be a little less costly, a little more easy to comply with. And like that should be very attractive to a lot of companies. And especially, I think we'll see a surge of like a lot of companies coming through this process very quickly and getting to the market where their brand can be recognized more fully than if they're just a private company, honestly.
Thank you again to our guest hosts, Chelsea Hall and Josh Gertsch. And thank you for listening.
This has been The Pre-Read, brought to you by Workiva, the world's only unified platform for financial reporting, sustainability, audit, and risk.
We've got more insights and hot takes coming your way, so be sure to follow or subscribe on Apple, Spotify, YouTube, or wherever you get your edge.
If you like the show, leave a review, send it to someone you love, or just shout it out on your next team call.
We'll see you next time, and until then, go lead it like you mean it.
I'm Mike Ravagno, and that's Alyssa Zucker. Segment reporting was done by Catherine Tsai. Audio engineering by Tanner Heinrichs.
Pedro Sousa is our graphic designer. Transcripts are created and edited by Courtney Kimsey. Thanks to our digital and social team, Mike Berg, Katie Carr, and Michael Karnowski.